For today's business brief, we're joined by Chief Market Strategist at Investsmart, Evan Lucas. Evan, thanks as always. Give us a sense of how the market's looking. It seems the volatility continues amid the dramas, the concerns about the China-US trade war.
Yeah, that's right, Kieran. It's probably even more than that. There's also a growing belief that we're actually globally facing a possibility of a recession. We actually got a warning sign in markets that we look at very closely, particularly from the US back in March. And I think because markets had been quite powerful through April and most of this month in May, we've probably forgotten that when you actually see US bond yields invert, which is where the US 10-year bond actually goes below the 3-month yield, that's actually a sign all the way back to 1900 that the US actually has a recession within 18 to 24 months of that happening. And that also is playing out. So yes, US-China trade war, particularly yesterday's news around the idea that China could use rare earths. They are actually the largest miner of rare earths on the planet, and 80% of it goes to the US. They could use that as a bargaining tool, inverted commas, with the US. So all that is playing out at the moment, unfortunately, and why the US markets hit a 3-month low last night.
Do you think if there is some grand deal achieved by Trump and Xi Jinping at the G20 at the end of next month, that would help arrest that trend, that the outlook would improve greatly? Because certainly the markets would receive it well.
It certainly would from a market. Yeah, exactly right. So from a market's perspective, it would certainly put that floor under the idea that this trade war is actually now getting further and further out of the sort of the levels that markets had. They expected tariffs to come through in 2018, which was what we saw, but not to go to the level we have now. Most market participants have always believed that a US-China trade, inverted commas, deal was going to come in on the idea that politically, particularly for President Trump, it plays out very, very nicely to actually see that negotiation. It would certainly help US companies. I mean, if you look at it, at a granular level, go down into a US company, the one to really look here is actually Apple. And the reason you point to that is that almost 70% of their products are manufactured in China and now have that 25% import tax. So that is politically good for him. It's also good for the markets. The catch at the moment, though, isn't just that. It is the fact that overall consumption globally is slowing, and there is a growing worrying trend that we are about to go through another slowdown period.
Do you think that the budget here, our government has a bit of a buffer in the sense that I see Shane Oliver from AMP Capital, he's suggesting that the boom in the iron ore price could see a surplus this financial year as opposed to the government's forecast for next?
There's actually an argument at the moment that we actually would probably enter a surplus this week. And that in itself is quite interesting. You're right. Not only do we have a boom in iron ore, it's above $100 a tonne. The fact that the Aussie dollar has now fallen to 69 cents. If you look at it over since basically the budget that's just been the one that was sort of delivered before the election, the average price of the Aussie dollar in that period has been about 70.5, which is above what the budget bottom line had, which was around about 74. So all of that improves it. The rule of thumb is that for every average dollar above expectations in iron ore, it adds around about $250 million to the bottom line, and the expectation had been for $75 a tonne. So we're well and truly above all of those metrics, and therefore, yes, we're in surplus. The argument that comes, however, getting back to what we've just been discussing, is around growth globally and also domestically. We know next Tuesday the RBA is going to cut rates. That's a given. And they could even do it, according to JP Morgan, 4 times. I don't think it'll be that hard, but they'll do at least 2. So we need to look at it from the point of view that fiscal policy, government policy, needs to come in. Now, credit to Frydenberg and also to Morrison. They do have an infrastructure spending, time frame and also, factored into what they're doing. But it is not necessarily going to be enough. And fiscal policy is going to have to be quite interesting.
Yeah, indeed. And just quickly, the election bump, what have you made of it? And in terms of property as well, is it tangible?
It is. You can't deny that. I mean, the other part of it is, again, the RBA. So the RBA's forecast of cutting rates is clearly going to help those that are looking for mortgages. It is a concern around a debt bubble, but look at what happened in mortgage brokers, private insurers and banks since the election. They were clearly under pressure from the idea that possible changes to negative gearing, CGT and franking credits have now been alleviated. So the market has probably corrected from that point of view. The question is growth going forward, and that's what we now need to wait for their earnings season in August.